Ladies and gentlemen, it is absolutely crucial that we delve into the current situations of the stock market, understand the intricacies of these companies, and safeguard ourselves from any potential harmful implications. In a world where financial markets are ever evolving, staying informed and making well-informed decisions is your strongest armor. Let's embark on this journey to explore the stock market's latest trends, focusing on Sofi, Paylor, and Neo, as well as some valuable insights we've gathered. Sofi, a prominent player in the financial services sector, has been making waves recently. With a consistent uptrend, it has gained attention due to factors like the resumption of student loans and a booming refinancing market. However, before we get too carried away, let's remember that trading is all about probabilities and making decisions based on odds. Sofi's charts reveal that it's in an uptrend, with higher highs and higher lows. It's tantalizing to think about the potential for a 50% price increase from $8 to $14 per share. But hold on, not so fast. Zoom in, and you'll notice something interesting. Sofi is dancing on a shorter-term downtrend within the context of that larger uptrend. It has encountered resistance levels multiple times, raising questions about its ability to break through. At the moment, it's stuck in a consolidation phase, which could lead to a potential dip. If that happens, keep your eyes on the $7.60 support level. A breakdown below that might bring Sofi down to $6.50, and that's when you should really be ready to act. Now, let's talk about Paylor. Paylor has undergone a significant transformation, with its stock surging by over 100 to 200%, from $7 to nearly $18 per share. But this journey has been quite the roller coaster. It was consolidating for months, trading in a range between $11 and $7. Just when it seemed to be forming a head and shoulders pattern and was expected to break down, it defied expectations and rallied impressively. What's next for Paylor? The target price is set at around $20 per share, and that's a tempting proposition. But here's the catch: the risk-reward ratio is not very favorable at the moment. The potential downside is substantial when compared to the upside, especially when you look at it from a trading perspective. Paylor is not offering the best risk-reward trade-off, but it's still important to acknowledge that the $13.79 support level is significant. If it dips down there, you might want to consider buying some shares or selling puts at that price. Finally, we have Neo, a company that has been on a relentless downtrend since 2021. Lower highs, lower lows, and a generally discouraging performance have made Neo the inverse of a V-shaped recovery. It's like a roller coaster that went up and came crashing back down. The current situation is a little concerning, and it doesn't paint a pretty picture for Neo. In fact, it's currently trapped within a very tight consolidation range. The worst part? It's beginning to look like a bear flag, a pattern often associated with potential downturns. With support levels at around $7.97, if Neo breaks down from this pattern, it could plummet to $7. Looking at it from a risk-reward perspective, Neo doesn't seem to be in the best position for a potential reversal. The risk is substantial, and the probability of success is relatively low. Now, as an investor, what can we learn from all this? First and foremost, it's crucial to understand that trading is about managing risks. There are never certainties in the stock market. We don't possess a crystal ball that can predict the future of these companies. What we can do, however, is assess probabilities, evaluate risk-reward ratios, and make informed decisions. One thing is clear from the analyses of these companies: risk-reward ratios are not created equal. Paylor might have a less favorable ratio right now, but it carries a higher probability of success. On the other hand, Neo presents a more attractive risk-reward opportunity, but the chances of a successful reversal are notably lower. Sofi sits somewhere in between, with a potential for a significant gain but uncertainty about breaking through resistance levels. The key takeaway here is to always have a well-defined risk management strategy. Whether you're a seasoned trader or a long-term investor, setting stop-loss levels is vital. These levels act as a safety net, protecting your capital from significant losses in case the trade goes south. In NIO's case, the analysis pointed out that even though the probability of a reversal is low, the risk-reward ratio is still favorable. This is where a strategic stop-loss can save the day, limiting potential losses. However, with Paler, which doesn't offer a great risk-reward trade-off but has a higher probability of success, you might consider a different approach. Instead of relying heavily on stop-loss orders, you could use fundamental analysis to determine your entry and exit points. Understanding the company's financial health and its future prospects becomes crucial when you're investing for the long haul. Sofi, with its intermediate risk-reward position, is the middle ground. Here, a combination of technical and fundamental analysis might be your best bet. Assessing potential breakouts, monitoring resistance levels, and being cautious with your entry points can make all the difference. The path you choose, be it trading for short-term gains or investing for the long term, must align with your risk tolerance and your objectives. Remember that there is no one-size-fits-all strategy. What works for one person might not work for another. So, what's next? The world of finance is ever evolving. Companies change, market sentiments shift, and economic conditions fluctuate. It's imperative to stay informed, continuously educate yourself, and adapt to the changing landscape. Keep an eye on the news, understand the factors that drive these companies, and be aware of macroeconomic events that could impact the stock market as a whole. As for the companies in question, Sofi, Paler, and NIO, their futures are still uncertain. The analyses provide valuable insights, but no one can predict with absolute certainty what will happen next. The only certainty is that the stock market is inherently volatile, and it's your responsibility to manage the risks associated with it. In the ever-changing world of investing and trading, knowledge is your most potent weapon. Understanding the technical and fundamental aspects of the stocks you're interested in can be the difference between success and failure. Always make informed decisions, set clear objectives, and never neglect risk management. These principles will serve you well on your financial journey. To drive this point home, let's consider an example. Imagine you invested in NIO without understanding its current downtrend and high-risk nature. You ignored the technical analysis, focused only on the potential for a quick profit, and decided to hold on to your shares. Suddenly, NIO experiences a significant drop, wiping out a substantial portion of your investment. With proper knowledge and analysis, you might have recognized the risk and either avoided the investment or employed a risk management strategy to limit your losses. The stock market is not just about buying and selling, it's about informed decision-making. It's about recognizing the potential implications of your actions, whether they lead to financial gain or loss. It's about understanding that even the most enticing opportunities carry risks that must be managed. In conclusion, the stock market is a complex and dynamic environment. It offers opportunities for financial growth, but it also poses risks that must be carefully managed. The analyses of Sofi, Paler, and NIO have revealed valuable insights, but they are not crystal balls. They are tools to help you make informed decisions based on probabilities and risk assessments. The takeaway is simple: educate yourself, continuously adapt to changing market conditions, and always have a risk management strategy in place. Remember that your financial well-being is in your hands, and with the right knowledge and approach, you can navigate the ever-evolving world of stocks and investments with confidence and resilience.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.